very good evening to all of you in Sydney. I'm Sami here from LSBF Singapore to conduct your paper P2 Corporate Reporting Masterclass today. And this will be an exam focused class for the coming December 17 P2 examination. Before I start, I welcome all of you. I hope you will benefit from this session. And I also would like to give my input to all of you so that you can do well in the coming exams, especially in the last minute, which I believe will be quite useful. Let me just briefly introduce myself. My full name is Saminathan. I've been teaching ACCA since 1996. My specialization are corporate reporting and finance. So I teach the P2 module, P4 module, F7, F9 and also F5. So I've been teaching ACCA since 1996, which is coming to about 20 over years now. Alright, and my objective in taking this class today and telling you what is important for the coming examinations is to let you know that P2 is not a very difficult paper. It is quite a simple paper in order to pass, and all you need to do is just focus on the techniques, which I'm going to tell you a few things based on the coming examination, and also try your best to do what you can. And the writing parts are quite substantial in this paper, so to do well in this paper you just need to be very focused on what is required for the coming exam, and that is the objective of this master class, to give you a good idea before you go for the examination. Right, I'll give you my best. If you have any questions, you're welcome to ask once I finish the session. You can check with me after the session, please. Right, and this paper is a discursive paper where you have accounting standard issues plus consolidation, advanced consolidation. So it is a mixture of advanced consolidation plus accounting standard issues, and that carries a substantial part of the paper. 50 marks of the paper is a case study, as you know. The other 50 marks you choose from 3 questions, you choose 2, and you notice that most of them will be related to accounting standard issues or consolidation issues. So what we have to understand here now is how to go about doing this paper. And for the coming exams, which is the December 17 exams, right, what we are looking at, key topics. The examiner is very consistent. Graham Holt is a very consistent examiner in UK, and he normally has the trend of setting questions in this manner. So for December 17 we are expecting question 1 to be a group problem related to complex groups. So we are looking at complex groups, which is the first area we'll be looking at in today's master class. And complex groups, obviously there are 2 things here. One is the vertical shape and the other one is the D shape. And this is what you must be very clear when you do your console, which will carry 35 marks in the paper, and you need to be very comprehensive and very focused in doing this, because the time you have is only about 1 hour. Once you finish the complex groups, there will be ethical issues related to 1 or 2 things in the question, and that will carry the remaining 15 marks in the paper. And once you are done with that, part B of the paper, you have accounting standard issues, and together with the complex groups you can have piecemeal acquisitions included, disposals included. All these are part and parcel of a big 35 marks question. So normal questions will have 2 to 3 paragraphs of standard issues and another 2 to 3 paragraphs of consolidation related issues. So you must be clear on how to do the consolidation clearly, and then you go into the standard issues. So I'll illustrate to you today how this is done before I go into standard issues. And the second part of our master class will look at accounting standards, and the accounting standards we will be focusing on some of the key standards with some of the scenarios set by the examiner. And this is what we are going to do today. So let's start with the first part today, and I believe all of you have the notes which have been given to you by LSBF Sydney. Alright, so let me run through some of the issues just to show you what came out recently. Alright, so these are the analysis of the recent examinations, so that I can, you know, what is been coming out in the last few examinations. So if you look at the last examination, which was September 17, please follow. September 17 they had a cash flow, they had FRS 102, they had FRS 36, FRS 109. These were the issues, even though the paper was not released. Based on what the examiner's report mentioned, we have analyzed these as the topics which have come out last examination. Cash flow is one of the hardest in console, so we are very lucky it came out last exam. This exam definitely you won't have a cash flow. 102 is share-based payment. 36 is a regular area. FRS 109 is your investments. Alright. 115 you're looking at revenue, and FRS 21 and FRS 109, which is overseas currency problems and derivatives, also tested last exam under issue. And to make it very clear, leases, the new standard is examinable from September 17, which is FRS 116, or international standard is IFRS 16. So IFRS 16, FRS 116 covers leases, which was fully tested in the 25 marks current issues last exam. So from coming exam onwards, all leases, FRS 17 has been removed, or IAS 17 has been removed, replaced with IFRS 16. That is the only new thing added in the syllabus from last examination. Other than that, basic standard coverage should be there. So I conduct this master class on the assumption most of you have gone through your principles or standards before listening to what I'm going to tell you today. And I believe you have done console problems by yourself before we start on the master class. So I'll just guide you along what is important for the coming exam, and you can benefit from it by looking at how we are going to go about doing it. Let me start with the first part today, which is the let me start with the first part today. Right, my first question today I've taken is a complex group question called Mini Bauer Hini, which is a full complex group, and this is how you look at a complex group question. The standard of the questions do not change, and the coverage of the question by the examiner is very similar in terms of style. Of course, figures and information may change, but the style of doing the question is very similar. Right, so look at this problem just to give you an idea. Mini is a company which operates in the service sector. Mini has business relationships, right, with Bauer and Hini. All three entities are public companies. The draft statement of financial position of these entities are as follows. Right, please check you have all the three. Investment by Mini in Bauer, investment by Bauer in Hini. So we are looking at a vertical group. A vertical group is where the subsidiary has an investment in another company. So we control the Hini through our investment in Bauer. That is a complex group. There is also an investment in Putin. Then you have an intangible asset. When you see an SOFP or statement of financial position in front of you, you can see that this figure here, which is the 730 and the 320, are the critical ones that tell you this is a complex group. Then you have intangible assets, and after intangible assets you have current assets, equity, liabilities and everything. Then we have the console paragraphs. As you can see, the console paragraphs are the first one. Mini acquired 70% of the interest of Bauer. Purchase consideration was 730. At acquisition, fair value of NCI of Bauer was 295 million. Fair value of net asset was 835 million, and retained earnings of Bauer were 390 million, and OCE were 27 million. Excess is due to land. Just get the key information, and the dates are critical, so please take note. 1st December 2010, Mini acquired 70% of the equity interest of Bauer. On 1st December 11, Bauer acquired 80% of Hini for a cash consideration of 320 million. Fair value of the 20% holding of the NCI was 72 million. 30% holding was 108 million, and a 44% holding was 161 million. At the date of acquisition, the net asset of Hini had a fair value of 362 million, retained earning 106, and OCE was 20. All this information has to be organized into a proper format for you to discover things like goodwill, NCI, and consolidated reserve. The three key workings you must produce correctly at this level is goodwill, NCI, and also the console reserve. If you can get these figures correctly, a lot of marks are given for correct workings, please. And there's a system to do it whenever it's a complex group, which I'll illustrate to you how we do it. Then there is an impairment test of the goodwill. Impairment tests are critical because goodwill must be impairment tested and not amortized under current standards. Then number 4 say, Mini acquired a 14% interest in Putin. Putin is a public limited company on 1st December 2010 for a cash consideration of 18 million. A 14% interest is simply an associate, and it's not even an associate, it is only a below 20. So below 20 is an investment. This investment was under current FRS 109. We call it fair value through OCI investment. Then we have all the other issues on the next page, which tells you that this is on the next page. You have, right, paragraph number 4. They bought an additional 16% interest. So that is a piecemeal acquisition merged into the question. 14 plus 16, total control becomes 30%. And Putin made profits after tax of 20 million and 30 million for the years. And Mini received a dividend from Putin of 2 million. Mini also purchased patents. This becomes a standard adjustment. So 3 paragraphs of consolidation and another 3 paragraphs of standard related issues. So if you look at the mixture of issues in your console, it is always mixed very well with console issues and standard issues. So this is why every time you do console, you must be very comfortable with the adjustments and how to go systematically one by one. And that is the objective of the masterclass today, to show you how to solve a big problem like this step by step without rushing through the whole thing in the time given to you. Then part B takes you into FRS 105, asking you about FRS 105, and also part C does some ethical and accounting implication related to FRS 105. These carry another 15 marks. So in a standard question for 50 marks, 35 marks will have console, 15 marks will have these issues inside. So let's look at how to solve this question paragraph by paragraph. Kindly keep the answer in front of you while I'll just run through how we go about doing it, please. And to do this, please follow. To do this, we go into if you start with the first part, which is the answer for this question, alright, just to give you the answer to this question, right, if you turn to the back, I have put out a detailed answer for this question, and how we go about doing it, let me illustrate to you. It's not difficult. Most important, please look at the ideas how we do it, alright, and I'll just illustrate to you based on experience how we do it, please. Step 1. Put out the group structure, who controls who, so that you don't get messed up. Dates are very important. Mini bought Bauer 70%, Bauer bought Heaney 80%. Date of acquisition is 1st December 10 for the first company. Kindly check the first paragraph. Second paragraph is 1st December 11 acquisition date. Right, so this is the structure. So it is a vertical group, and the logic is very important. We know Bauer first, then Bauer by Heaney. So the consolidation dates are correct. If I just switch the dates upside down in the exam and I tell you that this date is 11 and this date is 10, then you please understand our effective date, because if this date had been 1st December 11 for example, and this date has been 1st December 10 for example, then Bauer purchased Heaney before we purchased Bauer. So what happens is this date becomes irrelevant for consolidation, because we don't know our sub C until you know your direct sub C. So this date becomes irrelevant. But in this problem, it is a very simple flowing date. We know him first, he knows Heaney later. So when you do the consolidation, our problem company is not Bauer. Our problem company is Heaney, because Heaney is the third company in the line. The third company in the line, this is an examiner suggestion to cut short your consolidation. You have to use effective controls. That's why in the information there are so many numbers to choose from. You have to use effective control to consolidate. You know that Heaney is a sub-C. After you know Heaney is a sub-C, this percentage 80% should disappear. We don't use this in console anymore. So 70 out of 80, 56% becomes the effective control. And if 56% is the effective control, NCI is 44%. Alright, so if this is 44%, what is important is 56% will be used for goodwill calculation, 56% will be used for profit claiming, and 44% will be used for your NCI. The 80-20 doesn't come into your console at all when you do a complex group. This is the shortcuts of consolidating to finish it on time as given and recommended by the examiner. At the same time, please understand cost of investment. One of the cost of investment is in our SOFP. The other cost of investment is in the sub-C's SOFP. Whatever cost of investment in the sub-C's SOFP, split the investment into our share and the NCI share, because any asset in sub-C's balance sheet or SOFP, we can only take our share, and our share is 70% based on our direct control. So whatever you see cost of investment 320, claim 70% to do your goodwill working. The remaining 30% NCI share will go into NCI working. So please understand, this is how you look at the percentage and the COI. So any question on complex group, step 1, effective control. Step 2, split the COI before even you start anything on the problem. And this figure which I split 320 is found in Bauer's SOFP as investment in sub-C Heaney. This number of 320, we cannot take the full number to do goodwill because it is in sub-C's SOFP. Any sub-C's SOFP, we can only claim our share. That's the first issue you have to overcome on any complex group. Then we come into our basic working using information in paragraph 1, 2 and 3. Right. Using those information, we open 3 columns. This is a method called the schedule method in order to consolidate effectively. It is a very logical method with very minimal double entries involved and purely logic involved. We just arrange a spreadsheet. In doing this spreadsheet technique, how we do it is like this. Date of consolidation is today, which is 30th November 12. Date of acquisition is the day you gain control, 1st December 10 and 1st December 11, and console reserve is your third column. So what we do is, step 1, we look at the direct company we control, which is the easiest to consolidate. Those marks you cannot lose anything because direct control is very easy to consolidate. So we start with Bauer. Bauer's share capital is 400. OCE was 27 in paragraph 1. If you read, on the day you walk into the company, it was 27. Alright. Land fair value is always hidden. Fair value is never given. We don't know this figure. So this figure is the unknown. Retained earning on acquisition date as mentioned in paragraph 1 is 319. Put that all under acquisition date, because acquisition date we calculate goodwill. Consolidation date we calculate NCI. So put 400, put the 27, put the 319. Total fair value of net asset as required under FRS 103 is 835 under discretion. If net asset is 835, use the information given by the examiner to fill this up. Using this, work back the unknown 89. So the 89 is the land fair value hidden. And land has got no depreciation, so you have no problem taking this fair value in. Once you got the 835, we need to do full goodwill. Don't forget there is also partial goodwill in your syllabus. So we always do goodwill to be very comprehensive. Our share 70%, NCI share 30%. 70% is equal to 584.5. 30% is a 250.5. Got it? So if that is the case, COI is 730 as given in Mini's SOFP. We take full amount because it is in our own SOFP. Put the 730, compare with 584.5, our share of the net asset, you get our share of the goodwill. If you stop there, this is called partial goodwill. So doing only this column will finish a problem called partial goodwill. If you want full goodwill, then you do the NCI goodwill as well. NCI goodwill is based on the 30%. So if I follow the 30%, 250.5, fair value 295 will give you 44.5. If this is a 44.5, total full goodwill is 145 plus 44.5. So the concept of full goodwill is our goodwill plus NCI goodwill put together. This is what you will get as your full goodwill. And please take note, this goodwill later must be subject to impairment test. Right? So before you do the impairment test, finish the first column. First column is consolidation date. Consolidation date, the objective is to find NCI. So again we copy the share capital. OCE or other components of equity on top, you can see in the SOFP is 37. Land, copy back your 89. Retained earning today in Bauer's SOFP is 442. Add all this together is 968. 968 multiply 30%, which is NCI share, will give you 290.4. And before you go further, finish the impairment test as required under paragraph number 3. And paragraph number 3 clearly tell you both Bauer and Heaney were impairment tested at 30th November 2012. Recoverable amount of both CGUs or cash generating unit were given as follows. Bauer 1425 million and Heaney is 604 million. Alright, so the directors of Mini felt that any impairment of assets were due to the poor performance of the intangible assets. Alright, and also they told you a very important sentence at the end: the recoverable amount has been determined without consideration of liabilities. Anything that you do without consideration of liability will definitely involve anything. Don't consider liability means you're looking at total asset. So our impairment test cannot use net asset, we should use total asset. That's why whenever you do consolidation, please take note, we will have to be very clear with what is written for the impairment. In this case, it is based on total asset. If it is based on total asset, then we need to look at how to go about doing our impairment test. And the impairment test I've put in the earlier page to show you the idea. Alright, basic impairment test. I took Bauer's carrying value of the asset from the SOFP is 1130. 1130, fair value is 89, goodwill is 190, and carrying value is 1409. Alright, if carrying value is 1409, this is the total asset. Alright, if this is the total asset 1409, recoverable amount is 1425. If recoverable amount is 1425 as given in the question, obviously recoverable amount is greater. If recoverable amount is greater, there is no impairment. If there is no impairment, please take note, then we must understand that no impairment means we have to just carry on with the goodwill as it is. We don't need to impair any goodwill. If you don't need to impair any goodwill, then when you come down to the figures here, I have left the goodwill unimpaired. So what is important is you have NCI 290.4. The full goodwill of the NCI share is 44.5. So we take the 44.5 and add it to give you the NCI at fair value. This is what is called NCI at fair value. So when you touch the first paragraph, finish all the issues including the impairment. You did a full goodwill, you found your NCI in the first column, then you need console reserve. To get console reserve, basic consolidation tells you we can only claim the post reserve. We cannot touch any of the pre-reserve. So therefore, OCE you had 37 today. 37 less 27. 37 less 27 will give you 10. We claim 70% and take it to our OCE. 25 less 20 will give you 5. 5 multiplied 56%, alright, 5 multiplied 56% will go to, that's the later company. So this company is 37 minus 27 is 10, multiply 70%, we claim 7 and add it to our OCE. Retained earning, we organize our statement this way, is today minus what we had that day. Today 442, that day 319. 442 today minus that day 319 gives you 123. 123 is the post acquisition profit. Post acquisition profit, you can claim 70% our share, and that finishes first company's key working for Bauer. Please understand the logic. Copy the net asset, find the fair value hidden, finish our goodwill, finish NCI goodwill, you get full goodwill. Go to today net asset, fill up the numbers accordingly, give you net asset 968, take 30% 294, check impairment if there's any. If there's no impairment, please understand the numbers stay as they are. Take NCI goodwill, add it to the NCI, and you get NCI at fair value. Then take today minus that day, post reserve, claim our share. Post retained earning, claim our share. Retained earning goes into console reserve. OCE goes into OCE. So at the end of the day, 86.1 is our claim of profit and 7 is our claim of OCE from the first company, which is Bauer, which is an easy company to consolidate, and I've only finished the first paragraph information thoroughly. The concept you must understand is this: when you touch a particular paragraph, finish it, the examiner organizes information very neatly. Don't skip paragraphs and go to the next one and get totally messed up in the exam. Paragraph by paragraph, you clear by filling up columns like this. Life is very neat and very simple. Then we come to Heaney. Heaney's is the second paragraph. Second paragraph, if you follow, they told you clearly you bought it. Bauer bought 80% of Heaney. That's why we have to use effective control and split the COI, because Bauer purchased Heaney, not we purchase Heaney. So there is an indirect relationship or a sub-subsidiary for us. A subsidiary becomes our sub-subsidiary. So in such a case, Heaney got share capital 200. OCE that day, if you read paragraph number 2, is 20 million as given there. Alright. Excess in fair value is due to land. Retained earning that day in paragraph 2 is 106 million. Total fair value of net asset is 362 million. Alright. If this is a 362 million, missing figure is 36, which is land fair value. And look at the important things in red now. Whatever written in red are the key numbers in complex group. You cannot afford to lose marks by messing it up. 362, don't use the actual 80%. Shortcut to consolidation, use the 56%. And NCI, please use the 44%. If you take 362 56%, will give you 202.7, and your COI, don't copy what is given in his SOFP, claim only our share, which is 70% equal to 224. So 224 compare with 202.7 will give you a 21.3. 21.3 is a partial goodwill for this company. The other one is a 44%, 159.3. See, the fair value is given there in paragraph number 2, and the examiner has even given you a 44% worth 161 million and a 30% worth 108 million. The aim is to see which one would you choose, and many choose 30% wrongly, which is not supposed to be the correct percentage. Correct percentage should be the 44% effective again. So if you use a 44%, then 161 is the NCI to give you a 1.7 NCI goodwill. Then we come to today's date. So once you finish goodwill, you come to today's date, put out your share capital, OCE, put out your fair value and your retained earning. If you join the total up, it is about 400. Again, use 44%, which is your effective control, will give you 176. Release the goodwill 1.7. Total will be 177.7 if you want to work out the NCI before the impairment. So what happened now is there is an impairment test, very important. To do the impairment test, we go to our impairment working next. Okay, to do the impairment working, again it must be based on total asset, because questions say recoverable amount is excluding liability. So total asset means you don't take the liability inside. So I look at this SOFP, total asset is 595. That 595 is without any consolidation adjustment. So I put the fair value 36 for the land, and I put his goodwill current goodwill 23 inside. If I put the 23 inside, total becomes 654. 654 is the carrying value. Recoverable amount, question told you, is 604. 654 and a 604. Please take note, there is an impairment loss for this company, and the impairment is 50 million. Which is why the 50 million exceeds the goodwill we have of 23 million. Our aim was to test for impairment, but the impairment exceeded the goodwill amount. If impairment exceeds the goodwill amount, question must tell you where to charge that extra loss. And paragraph number 3 clearly said it was due to the poor performance of the intangible asset. That means additional losses must go to intangible asset. So what we did is this: we took the 50 million and we took our share. Our share is 56%. 56% of 50 million is 28 million, which charged to our retained earning, which means our profit goes down. The 44% goes to NCI. So NCI takes 22 million, and the double entry for this, credit your goodwill and close it to 0, because at the end of the day goodwill is fully impaired due to 50 million. Additional losses you got to charge it to intangible asset as required in paragraph 3. Therefore, logically, total 50 million, our share, NCI share, goodwill close to 0, additional loss charged to intangible asset. So if you do this, you can easily work out what is required for our next problem, which is coming to NCI working. So the goodwill is impaired fully, 21.3, 1.7, I made it 0. Once you make it 0, then come to the first column, please. In the first column, NCI had 512.6 total, including the goodwill inside. Now total impairment of NCI is 22. Reason: the 22 includes goodwill and the intangible asset, everything which is all who share, NCI share. And the last step, please don't forget, the COI, we took only 70%. We left behind 30% for the NCI, and that COI is deducted from the NCI. And when you put the COI 30%, you minus here. The reason for minusing is very simple. NCI is a credit balance, COI is an asset debit balance. Credit debit you deduct will give you NCI 394.6, and this figure will go to your statement of financial position. And statement of financial position will take an NCI of 394.6. At the same time, goodwill left behind is only for one company, because the other company has impaired fully. Therefore, this goodwill left is only 190 million. So at the end of the day, these two figures, if you get it correctly, a lot of marks are awarded. So please look at the system. It's very simple. Organize paragraph 1, paragraph 2, paragraph 3 as I've done just now. Just fill up the blanks using the information, and marks are flowing in easily as you finish the paragraphs. Then we come to the last paragraph. Please follow. The last paragraph is always the post reserve, and the post reserve, how you do is, again we go to OCE. Today 25 for Hini, that day 20 for Hini. 25 minus 20 is a 5. 5 multiplied 56% is a 2.8. This must be taken to OCE. Alright. Then the retained earning, we have a 139 and you have a 106. 139 and a 106, again today minus that day. Today 139 minus 106 that day will give you a 33. 33 we claim 56%. If you claim 56%, that is a 18.5. So total profit we claim 86.1 from the first company and 18.5 from the second company. So automatically total claim become 104.6. Up to this point, please take note, we have cleared paragraph 1, paragraph 2 and paragraph 3 completely done. You don't have to come back to these paragraphs again because you have to finish the question in the time given to you. So if you finish the 3 paragraphs, then we come to the next part. Next part, we have to plus our retained earning, because group retained earning or console reserve is our retained earning plus what we claim from the subsidies. So total is 104.6 plus 895. To this we knock off the goodwill impairment, and the goodwill impairment is 28 just now as we saw in the working, and that will reduce the retained earning. And by doing this, we finished everything in the first 3 paragraphs. Then we come to the 4th paragraph where an investment has become an associate. Every console question will have at least one company where relationship change. When relationship change, it could be through piecemeal acquisition, could be through disposal, which is part and parcel of one of the adjustment in every exam. So please get ready all your piecemeal and disposal understanding. In this case, investment has become an associate. So please take note, investment is treated under FRS 109 or IFRS 9. Is switch over now to FRS 28 or IAS 28. So associate treatment is IAS 28. We don't do goodwill and all that for associate. So associate is very simple. Using IAS 28, we go to interest in associate called put-in. And put-in is in paragraph 4. And paragraph 4 clearly says, Mini acquired 14% interest in put-in. This was on 1st December 2010 for a cash consideration of 18 million. Investment was accounted for under FRS 109 current standard. The old one is 39, alright, and was designated as the fair value through OCI. Last time they used to call it available for sale. On 1st June 2012, Mini acquired an additional 16% interest in put-in, alright, for a cash consideration of 27 million and achieved significant influence. So that means it has become an associate, alright, and the value of the original 14% investment is now 21 million. Put-in made profit after tax of 20 million and 30 million for the years to 30th November 2011 and 30th November 2012. Respectively. On 30th November, Mini received a dividend from put-in of 2 million, which has been credited to OCE. This is complete understanding of IAS 28, which is calculating interest in associate. As you know from IAS 28, associate reporting is one line in your SOFP, and to calculate that one line, you take COI plus post-acquisition RE of associate minus any impairment of associate. This is the formula to do associate. So put-in, please take note, we had 14%. 14% examiner told you they bought originally for 18 million, alright, but you can't use 18 million today when it becomes an associate, because basic FRS 103 principle is previous acquisition must be brought to current fair value on the date it becomes an associate. So 18 million today is worth 21 million. If it is worth 21 million, please take note, you must take this 3 million, and according to the question, even if you look at the SOFP they put investment in put-in as 48 million. How they got 48 million? The 3 million is already taken in, because 18 million, 3 million give you 21 million. Today you paid 27 million. Total your SOFP shows 48 million. That means the 3 million is already recorded under investment today. and this is a fair value through OCI investment. IFRS 9 says gain or loss must be taken to OCI, OCE, not to retained earning. Alright, only fair value through P&L, gain or loss goes to retained earning. So since the 3 million is already taken in, when you change to an associate, this must be released out of OCE. Reason, you cannot hold this under OCI, OCE anymore because it's no more an investment today. After the piecemeal acquisition, it has become an associate. Associate, you must take out from IFRS 9 and put it into IAS 28. So you're changing from one standard to another standard. So therefore, 21 million, 3 million you debit OCE and credit the RE of M. The reason for doing this is this has already been recorded and we need to make sure that this figure which is recorded is eliminated or taken out of OCE. Then the 16% you paid today is still 27 million. So the 30% is worth 48 million. If 30% is worth 48 million, you plus the associate profit only for half a year. Why half a year? Because it became an associate only on 1st June 2012. June 2012 to November 2012 is only 6 months. That 6 months you take 30 million, multiply half a year, which is the profit of put-in. You can see the profit of put-in is given to you on the second page of your question, which they tell you clearly this year's profit was 30 million. 30 million you must take half a year. Half a year multiply 30%. When you multiply 30%, it is our share for half a year. So proportionately, we claim the associate profit 4.5 million and minus any dividend received from put-in. So you minus dividend received 2 million will give you interest in associate 50.5 million updated. So IFRS 9 has been switched to IAS 28. Associate has been recognized. Every examination when console is set, don't forget they will give you complications with either associate. If associate don't come out, joint venture JV will be there, FRS 111. So please take note, this is how you do associate using IAS 28. Once you finish that paragraph, all the console paragraphs are done constructively with a system in your mind. Once you got that, it is very difficult to go wrong in the marks here. A lot of marks are given for doing these paragraphs constructively. And associate OCE, I add the 3 million just now because that is added to RE. Associate profit, dividend I took 2, profit I took 2.5, total 4.5. So associate profit we claim 4.5 including the dividend inside. So please take note, this is how you play with associate. Then we come to the 2 paragraphs remaining, and the 2 paragraphs remaining are standard related. And standard related paragraphs, you have to sort them out using the right FRS. So if I look at paragraph number 5, clearly stated, mini purchase patent 10 million to use in a project to develop new products. So before you come to the standard paragraphs, finish all the console paragraphs one by one, which are all arranged in order. So it's very safe to just glance through the question and start paragraph by paragraph, sorting them out one by one. Alright, so paragraph 5, mini purchase patent 10 million to use in a project. So you know this is IAS 38, which is intangible asset. So patent to use in a project to develop new products. On 1st December 2011, Mini has completed the investigative phase of the project, incurring an additional cost of 7 million and has determined that the product can be developed profitably. An effective and working prototype was created at a cost of 4 million in order to put the product into a condition for sale. A further 3 million was spent. Finally, marketing costs of 2 million were incurred. All the above costs were included in the intangible assets of Mini. Right, all these are inside Mini. They are testing your understanding of IAS 38. What is the issue in IAS 38? IAS 38 clearly say for research and development, research costs cannot be capitalized. Only development costs can be deferred and taken to deferred development expenditure. So in this case, they bought the patent for 10 million, that is alright, but they incurred an additional cost of 7 million for investigative phase. Listen, investigative phase 7 million cannot be capitalized. At the same time, marketing cost of 2 million, alright, cannot be capitalized as well. So the prototype 4 million can be capitalized, and a further 3 million was spent to put the product into condition for sale, that is also development, but the marketing cost 2 million cannot be capitalized. So what you must do, from the total they have put in wrongly, remove 9 million, 7 for the research cost, 2 for the marketing cost, total 9 million, debit RE of M 9 million, credit intangible asset 9 million. Using FRS or IAS 38. That will finish that one paragraph completely. Most adjustments involving standard, you should look at it from the double entry point of view. Graham Hall expects you to know your double entries to solve these problems based on the standard requirement. So stick to double entry and see what you can get out of it. Then paragraph 6, Mini intends to dispose of a major line of a parent's business operation. At the date, the held for sale criteria were met. This is FRS 105. And the carrying amount of the asset and liability comprising the line of business were PPE 49 million, inventory 18 million, current liability 3 million. Got it? It is anticipated that Mini will realize 30 million for the business. No adjustments have been made. No adjustments have been made, alright, in the financial statement in relation to the above decision. So, no adjustments have been made in the financial statement in relation to the above decision. That means to say, please follow. This is how you must analyze FRS 105. If you analyze FRS 105, it's a held for sale disposal group. So what is important is this: held for sale assets must be classified differently and cannot be left under IAS 16, because 16 assets are assets that you depreciate and you carry on. So therefore, please take note, minus from PPE 49 million, minus from inventory 18 million, because these are all included for the held for sale, and take out from your current liability 3 million. So carrying value becomes 64 million. Alright, if it is 64 million, fair value less cost to sell is 30 million as given in the question. If it is 30 million as given in the question, please take note, there is an impairment. So anything held for sale, you don't depreciate those assets, you only run an impairment test. So 64 million compared with 30 million, there is a $34 million impairment loss. Alright, impairment loss, please take note, must debit retained earning and credit held for sale operation. That's it. It's very simple to handle his adjustment. Read the adjustment carefully, think in terms of the standard, debit credit. Of course your standard must be strong to understand this. Do the debit credit and sort it out. Once you sort it out, please take note, this will give you, yes, this will give you the adjustment here, and the adjustment here we put under impairment. So if you put it under impairment, please take note, R&D I minus 9 million and impairment held for sale, I have minus another 34 million to give me a 936.1 million, which is the group retained earning. And that completes the 3 columns which are the critical paragraphs for you to understand. So this is the goodwill, this is the NCI, and this is your retain. These are the basic mechanics which must be integrated with the entire problem. So all the 6 paragraphs you sorted out, then we can go about doing our consolidated SOFP. So what we are going to do next is we are going to update all this information into the SOFP. And to update this into SOFP, what we need to do is we come to the consolidated statement of financial position. Once you reach this stage, you should not be reading the question anymore, because finishing all these workings will take you about 45 minutes if you focus and do it. 45 minutes maximum 15 minutes. Then you have the balance 10-15 minutes to do your SOFP. Doing the SOFP is absolutely straightforward if you have done your adjustments and put out all the entries in the first 45 minutes. So all the workings are ready. There's nothing to read anymore in the question. Keep the original SOFP in front of you. Do plus minus and start filling up at top speed. How do you do that? Non-current asset, start with intangible. Intangible originally you already found just now in your working. Goodwill is 190 million from your second column. Don't forget, 3 columns works very well for any SOFP question. Use the 3 columns productively in the coming exam if any SOFP problem is tested. It could be simple group, it could be complex group, it could be anything on SOFP. If they ask you to consolidate, the 3 columns will help you simplify your workings easily. So, intangible, we have goodwill 190. Other intangible asset, you have 198 plus 30 plus 35, the original, minus the 27. What is this 27? Please take note. 27 refers to the impairment with the goodwill, you had 27. The 9 refers to the research cost and the marketing cost, which will give you 227. Then PPE, property, plant and equipment, 920 plus 300 plus 310 plus 89 for the fair value increase, plus 36 for the fair value increase, minus 49 for the held for sale, because PPE must remove from PPE. So 49 is the held for sale. These two are the fair value increase for land. So whatever you have done in your previous working will come to your mind. You just plus minus following your working. So that will give you a 1606. Then you have interest in associate put in. Associate reporting is 1 line, you don't add line by line, which is a 50.5. Current asset you have 895 plus 480 plus 250 minus 18. And what is this 18 for current asset? The held for sale current asset again. Alright, held for sale will give you 1607. Then held for sale disposal group asset. When you publish your SOFP, asset one side, liability the other side. So what we do is we take the 30 plus 3, follow? 30 plus 3, because we are looking at current asset here. Please follow. 30 plus 3, and 30 plus 3 refers to your inventory 18, your PPE is 49, but don't forget these have already changed in value now. The last is 30. 30, I add back the current liability 3 to disclose total asset 33. So total asset is 33, then the liability on the held for sale will go under liability section separately, because you cannot put just one item net asset, because this section is all total asset without deducting any liability. So we come down to the next section, which is equity and liability. Right, equity and liability, if you follow, we have the following to capture. Share capital, hours 920. OCE, very important, hours is 73. Plus today minus that day, the post movement 7 just now you had for the first company. 2.8 is the post movement for the second company. Minus 3, minus 2. What is all this? This refers to the associate, which you remove the gain from OCE, and this minus 2 refers to obviously we are looking at another minus 2, and this minus 2 is the 3 is the debit OCE here, this figure, and we claim all the today minus that day here, which is the 2.8 and the 7. Alright, and also after that, please take note, if you come down further, you have these figures, and here dividend should be credited to M's P&L and not OCE. So all dividend should go to P&L, but they have put it in OCE wrongly, so you got to minus another 2 under the associate. So when you come down to your associate working, you have got to look at the OCE with the -2 inside, and with the -2 this is 77.8, and retained earning is your last column answer, which is 936.1. okay, so this will give you your equity. Then you put in your NCI. NCI is the first column working, which is 394.6. Non-current liability, you had 495, 123 and a 93. Alright, so this will give you 711. Then we come to current liability, which is 408 plus 128 plus 138 minus the 3 out from here, and leave it separately as a held for sale disposal group liability. So don't forget that held for sale must be disclosed separately, and your balance sheet will tally, or SOFP will tally perfectly. And this is how you earn your 35 marks in a complex group. And the critical thing in a complex group problem, as I've been telling you from the beginning, is you need to be very clear on the shortcuts where you take the control as effective control to consolidate, and the COI you must split our share and NCI share. If you can do that, then life in consolidation is absolutely straightforward. There is no issues at all. So this is how you earn the 35. Once you got the 35, you go into the other issue. The other issue is related to things like, they will ask you on whatever things set in the case study, something on the standard they will ask you. So if you look at the problem in the second part, it is clearly stated, Mini intend to dispose of a major line of business in the above scenario, and the entity has stated that the held for sale criteria were met under FRS 105, and the criteria in FRS 105 are very strict, and regulations have been known to question entities on the application of the standard. The two criteria which must be met before an asset or disposal group will be defined as recovered principally through sale are: it must be available for sale immediately in its present condition, and the sale must be highly probable. Discuss what is meant in FRS 105 by available for sale immediately in the present condition, and the sale must be highly probable, setting out briefly why regulators may question entities on the application of the standard. So basically here what you have to be saying, telling them clearly is, what do we mean by sale is highly probable, and what do you mean by sell in the present condition? One of the key conditions, if you go back to FRS 105 or IFRS 5, is, alright, there must be a highly probable sale within 12 months. Got it? And it must be made available for sale immediately in its present condition. Okay, why do they put these two conditions? Why do the regulators want to have these two conditions? Okay, available for sale in its present condition means if the entity has the intention and ability to transfer the asset or disposal group to a buyer. There's no guidance in the standard on what constitutes available for immediate sale, but the guidance has set out various examples. Customary terms of sale such as surveys and searches of property do not preclude the classification as held for sale. However, present conditions do not include any condition that have been imposed by the seller of the asset or disposal group, such as if planning permission is required for sale. So in this case, the asset is not held for sale. The problem is determining whether the entity truly intends to dispose of the group of assets. So there must be a clear intention to dispose the asset. So if you don't do any renovation or anything to the property, for example, because if you do renovation etc., you don't have intention to sell immediately, and in case you want to use it again, you do renovation, then better don't classify it as held for sale. At the same time, there must be a highly probable sale. What is a highly probable sale? A sale is highly probable where it is significant, more likely than probable, that the sale will occur, and probable is defined as more likely than not. FRS 105 attempts to clarify what this means by setting out the criteria for a sale to be highly probable. These criteria are: there is evidence of management commitment, very important, active program to locate a buyer and complete the plan, you must be actively marketing it. for sale at a reasonable price. Another key criteria. So you just come to the criteria and explain. You have answered the 7 marks. And the sale is expected to be completed within 12 months of the date of classification. And actions required to complete the plan indicate it is unlikely that there will be significant changes to the plan or that it will be withdrawn. And because the standards define highly probable as significantly more likely than probable, this creates a high threshold of certainty before recognition as held for sale. And FRS 105 expands on this requirement with some specific condition, but the uncertainty still remains. Obviously, standard requires you to sell within 12 months. And you must be serious about selling it, because putting it under this standard gives you certain privileges, like you don't need to depreciate. If you don't depreciate, your bottom line or profit becomes higher. So classifying it as held for sale, you must be serious about selling it within the coming 12 months. That's what you mean by there is a highly probable sale, and that's the first part. Then the third part, see, all these are writing marks, so you cannot afford to sacrifice them. So your console must be completed within the first 1 hour, maximum 1 hour 10 minutes. You need about 20 minutes to write a reasonably good answer for B and C. Once the 50 marks is in your pocket, it is very easy to do section B. Then your confidence level also goes higher and the paper is easily passable. So please understand, doing the console within the time given is the critical part. Writing all this, I think, is not a difficult problem for most students, because the language level required and the standard English required are quite common. So part C says, Bauer has a property which has a carrying value of 2 million at 30th November 2012. The property had been revalued at the year end, and a revaluation surplus of 400,000 had been recorded in OCE. The directors were intending to sell the property to Mini for $1 million shortly after the year end. Bauer previously used the historical basis for valuing property. Carrying value 2 million, you did a revaluation 400, property value is 2.4 million, and you want to sell the property to Mini for 1 million shortly after the year end. Why do they want to do all these funny things here? Alright, again, this brings you into ethical issues. Alright, and you are selling the property below the fair value, and if you are selling it below the fair value without adjusting your answer to part A, discuss the ethical and accounting implication of the above intended sale. And this is what we call ethical issue. Will always be one part of question 1. And every exam, this ethical issue is the easiest part to claim the answer. So a company may distribute non-cash asset. The transfer of the asset from Bauer to Mini amounts to a distribution of profit rather than a loss on disposal. The shortfall between the sale proceed and the carrying amount is $1 million, because question clearly said that they want to record, the directors want to sell the property to Mini for 1 million. So the shortfall between the sale proceeds and the carrying value is 1 million, and this will be treated as a distribution. Bauer has a retained earning 442 million available at the year end, plus the sale of the non-current asset will realize an additional amount of 400,000 from the RR. Distributions may only be made from distributable profits in Singapore. In simple English, you are increasing the profits available for dividend. The Companies Act does not define distributable profit, but in many countries this is taken to be accumulated realized profit less accumulated realized losses. If the transaction meets the criteria of FRS 105, then the asset will be held in financial statement of Bauer in a separate category from PPE. Alright, separate category from PPE, and measured at the lower of carrying amount of held for sale and fair value less cost to sell. So if asset is held for sale, IAS 16 do not apply. So the boundary between ethical practices and legality is sometimes blurred. So questions would be asked, to the directors why they want to sell an asset at half the current value, assuming 2 million is the current value and 1 million is not a fair approximation of fair value. This may raise suspicion, and this involves the development and disclosure of information which should be truthful and neutral. Both Bauer and Mini would need to make related party disclosure, because the transaction is done at a privileged price as well. And the nature and responsibility of the directors require a high level of ethical behavior. Shareholders, potential shareholders and other users of financial statement rely heavily on financial statement of a company, and they rely on the directors to present a true and fair view of the company. So doing things like this creates suspicion among shareholders, and are we doing the right thing by selling at half the price? Unethical behavior is difficult to control or define, but it's likely that this action will cause a degree of mistrust between directors and shareholders, unless there is a logical business reasoning behind. That's why when you do this kind of transaction, you must explain why did you sell at such a price. If it is to eliminate overdrafts on the last day on the SOFP, then it's totally unethical. And shareholders in Singapore who receive an unlawful dividend are liable to repay it back to the company. So at the end of the day, this is unethical behavior. They should minimize this kind of behavior which creates suspicion. And using your accounting framework, accountants have the responsibility to do faithful representation and disclosure of financial information to shareholders. Therefore, if you do things like this, you are creating more suspicion and doubt on your professionalism. So this kind of things should be minimized, and everything should be done above board. So this kind of transactions which are not explainable should be minimized as much as possible. That's what the last part C is about. So by doing this, you complete a 50 marks problem successfully. So to do section A, this is what you must understand. And if you know that, then we can go into section B. Section B, we are looking at how to go about answering issue-based question. So this examination, right, I'm quite certain that it will be a complex group or definitely an SOFP. It's not a cash flow year or a P&L year. It is definitely an SOFP year. But just as a backup, you can do the P&L and keep as well. So if SOFP comes out, the 3 columns I've explained to you today will guide you and take you through the entire problem if you do paragraph by paragraph as given in the question. And it is very simple as you have done today. Handle paragraphs one by one, release the information in the right places, and complex group follow the rules created in FRS 110 or what we call as IFRS 10. Use the rules clearly from there, and consolidation becomes very easy with the shortcuts. So remember 2 things. One is split the COI. 2 is don't use actual control, please use effective control. So effective control and splitting the COI are absolutely critical for you to get your computations correct. And this is what you must understand in a complex group. And keep the 3 columns which we call as the schedule method to solve your problem, and all standard adjustments please run through your double entries using the standard requirement. And by now standard knowledge should be thorough, which is very important to answer section B. So section B, you are given 3 questions, you choose 2. Choosing the 2 questions, normally question 4 is a recent development. Question 4 is a recent development. If you are reading widely, you should take question 4. But question 2 and 3 have got lower risk because they got A, B, C, D. A, B, C, D come from different parts of the syllabus. So even if A you go wrong, B you can't go wrong. So therefore, A, B, C are different standards. Most students prefer those 2 questions, which is question 2 and 3. Because question 4 comes from only one part of the syllabus, which is a new development or current development. Or it could be one standard alone by itself, like IFRS 9. And those are never easy to solve, which is why the least popular question in P2 is always question 4. The most popular ones are question 2 and Question 3 always selected by candidates. So today we will look at two questions on question 2 and 3 to show you how to answer issue based question in 45 minutes per question. Again, time constraint, don't forget you only have 45 minutes. So picking up keywords on issues based question are very important when you do the issue based. So to see the issue based, please look at the next question which I've collected for you today. I took two recent questions from the last examination paper released by your examiner, alright, and one of them is Kasun, alright, and the other one is a question related to Kanto, alright. Both are very good with the key standards tested, please. So let's run through these two to see the idea of how to go about doing issue based. Right, second question is on page 9 of the handout which has been sent to you. Please see. Kanto Company is a company which manufactures industrial machinery and has a year end of 28 February 2017. Please understand, it is a reporting date here, and the directors of Kanto require advice on the following issue. And you can see there are 3 to 4 issues which you need to advise them. So let's start with the first issue. First issue given in front of you. On 1st March 2014, Kanto acquired a property for 15 million which was used as an office building. Kanto measured the property on the cost basis in PPE. That means they have applied IAS 16. The useful life of the building was estimated at 30 years from 1st March 2014 with no residual value. Depreciation is charged on the straight line basis over the useful life. At acquisition, the value of the land content of the property was thought to be immaterial. During the financial year to 28 February, the planning authorities approved the land to build industrial units and retail outlets on the site. During 2017, Kanto ceased using the property as an office and converted the property to an industrial unit. Kanto also built retail units on the land during the year to 28 February 2017. At 28 February 2017, Kanto wishes to transfer the property at fair value to investment property now, which is IAS 40. This valuation was based upon other similar property owned by Kanto. However, if the whole site was sold, including the retail outlet, it is estimated that the value of the industrial unit will be 25 million because of synergies and complementary cash flow. The directors of Kanto wish to know whether the fair valuation of the investment property is in line with Singapore FRS and how to account for the change in use of the property. So look, the requirement is all here. They want to know whether the fair valuation is in line with Singapore FRS and how to account for the change in use of the property in the financial statement at 28 February 2017. The whole thing is mixing 3 issues if you read carefully. One is IAS 16, the other one is IAS 40, and the third one is fair value, which is IAS 13 or IFRS 13. We call it FRS 113 in Singapore. So this issue is fully on these 3, and I always prefer to write his answers to the point, introduce the standard. The logic of writing this kind of answers is introduce what the standard says, link what you have introduced to what the question requires. If you can have that flow, professional marks are also given to you for introducing the standard first before linking to the scenario. So if you look at my answer for this, I've put it down clearly at the back. Alright, the answer for question 2, if you follow, alright, on Kanto is, we have the answer for Kanto, we have the following, please see. Right. So this is how I would write a simple answer in the time given. This is the June 17 question, just to let you know, and this is how you should be writing a simple answer. First issue is FRS 113. What is fair value? That's why this is a recent standard, IFRS 13. please define what is fair value to see whether the company has followed that fair value properly. Fair value is a price received to sell an asset in an orderly transaction between market participants at the measurement date. The price is based on the highest and best use for a market participant. And I left my answer here because in the time given, it is impossible to write an answer like what the examiner has given in the model answers. What can we write in the time given? I'm clearly concerned about that. That's why I gave you what answer I would have written in that time given, so that at least it guides you what you should say rather than going all over the place as what the examiner's answers normally do. Alright, so fair value is the price received to sell an asset in an orderly transaction between market participants at the measurement date and is the highest and best use for market participant. Canto's property valuation of 20 million, please take note, that is a 20 million property valuation, is not an active market value. Got it? It is not an active market value but based on similar properties owned by Canto. However, FRS 113 requires market-based valuation. That's the problem with this company if you read carefully. They have valued based on similar properties owned by Canto. That is level 2. But recommended practice in FRS 113 is level 1 input. So you require market-based values to determine fair value. Therefore, 25 million fair value based on industrial unit with synergies and complementary cash flow would be more appropriate, but it is still a level 2 input measurement based on similar industrial property and not market observable price. So the best price you can find is market based observable price, which is not given in the question. So even if you use 25 million, it is better than 20 million, but it is still not the best price using FRS 113, which require a market based observable price, which is not there. This is the problem with the first part. Alright, then in the same issue we come to FRS 16 and FRS 40. Change in use was approved on 28 February 2017. There are numbers given, so please follow. Using FRS 16, alright, you must apply FRS 16 or IAS 16 until 28 February 2017. Cost is 15 million. Divide by 30 years. Multiply by 3 years. Accumulated depreciation is 1.5 million, out of which $500,000 depreciation is charged to P&L using FRS 16. So carrying value is a 13.5 million. So your revaluation reserve must be taken to OCI OCE 11.5 million to bring the asset to 25 million. 25 million is the fair value as a what property? As a investment property to start IAS 40. So you must remember there are two standards coming in, 16 in the first half, 40 in the second half. On 28 February 2017, property will be transferred to FRS 40. From next year, FRS 40 recommended practice is no depreciation, compulsory to fair value every year, and gain or loss should be taken to P&L. No OCI OCE under IAS 40. So when you talk good answers for issue, it must be fully focused on the standard. One of the complaints by the examiner and the examiner's report regularly is students lift paragraphs and copy into the answer. No marks are given for any paragraph lifted and copied inside. So minimize lifting paragraphs, maximize your analysis and application of the standard. So if you want to write a good answer, be very focused to what is required. So first part you must say FRS 113, it is not a very good valuation because 113 wants an observable market price. Second part you can use 16. You can use 16 until 28 February 2017. So you must remember 3 years is inside, out of which current year $500,000 is still under IAS 16 charged to P&L. Last day you do an RR, RR goes to OCI, OCE, and you transfer the 25 million over to IAS 40. And IAS 40 next year onwards, you recommend a practice of no depreciation as required by the standard, and just fair value every year. Whatever you fair value every year, gain or loss must be taken to profit or loss. This is how you answer the first part, specifically to what is required. Then if you look at B, B says on 28th February, Kanto acquired all the share capital of Bin Lorry. Bin Lorry is a company which manufactures and supplies industrial vehicle. At the acquisition date, Bin Lorry has an order backlog which relates to a contract between itself and a customer for 10 industrial vehicles to be delivered in the next 2 years. Backlog order is actually an asset when you take over a company. All intangible assets that exist must be recognized as a fair value adjustment. You know this from IAS 38 and the fair value FRS 103. In addition, Bin Lorry requires the extensive use of water in the manufacturing process and can take a predetermined quantity of water from a water source for industrial use. Bin Lorry cannot manufacture vehicles, vehicles without the use of water rights, and Bin Lorry was the first entity to use water from this source and acquired this legal right at no cost several years ago. Bin Lorry has the right to continue to use the quantity of water for manufacturing purposes, but any unused water cannot be sold separately. These rights can be lost over time if non-use of the water source is demonstrated or if the water has not been used for a certain number of years. Bin Lorry feels that the valuation of these rights is quite subjective and difficult to achieve. The directors of Kanto wish to know how to account for the above intangible asset on the acquisition of Bin Lorry. So this is purely acquisition, FRS 103, with a lot of intangible asset inside. So your answer must focus on the right standard, and it's important to mention the standard before you start writing your answer, which shows comprehensive knowledge. So if you look at my answer again, this is what I would have said if I were to write an answer in the time given. FRS 103 say acquirer should recognize, acquirer should recognize separately from goodwill any identifiable intangible assets on acquisition. So there are two keywords here. Identifiable means separability. It is identified separately from the business, or there is a contractual legal criteria. Two important things in 103. It is identifiable means there is separability or contractual legal criteria. So if you apply this FRS, please take note, this is what you will see. Alright, if you apply this FRS, you have to look at, in Kanto, please follow, acquisition of B. So once you explain the first part, introducing the standard, come to Kanto now. Acquisition of B, there is an order backlog. Order backlog must be treated as an intangible asset on acquisition because the business comes with a lot of orders in the pipeline. And fair value must be based on expected revenue. Fair value is an expected revenue less cost to deliver the product or service. With respect to water acquisition right, it was acquired at no cost, and renewal is certain with no cost as well. Also, the rights cannot be sold, and B will lose the rights if you did not use the water. Therefore, the legal right cannot be measured separately from the business. So you come back to the standard and you're linking it to the scenario where there's no separability. So standards say there must be separability, but the scenario, this shows no separability. So the rights cannot be sold, first issue. You cannot sell it separately. You will lose the rights if you do not use the water, and the legal right cannot be measured separately. Therefore, it is an integral part of the business operation, and because it's integrated into the business operation, alright, is integrated in the business operation, and the legal right should not be accounted for as an intangible asset. So you must be very clear with how you write. You must give the decisions clearly and write proper flow of ideas when you do this. So it is an integral part of the business operation. Therefore, legal rights should not be accounted as an intangible asset and cannot be separated from goodwill. Therefore, we must understand that one of them, which is the backlog of orders, can be a fair value adjustment on the date of acquisition. So please understand, the fair value adjustment, what you can take and what you cannot take, are clearly specified under FRS 103. So the key word is separability. If you cannot separate it from the integrated part of the business, that intangible asset is impossible to recognize. Those are the key things you must mention in a good answer. Then we come to the examiner's favorite, FRS 36, which is all over the place in P2. Please understand, FRS 36 is a critical standard, please. So if you look at part C, Kento acquired a CGU several years ago, but at 28 February 2017, the directors of Kento were concerned at the value of the CGU has declined because of a reduction in sales due to new competitors entering the market. At 28 February 2017, the carrying amount of the assets in the CGU before any impairment testing were goodwill 3 million, PPE 10 million, other assets 19 million, total 32 million. The fair value of the property, plant and equipment and other assets at 28 February 2017 were 10 million and 17 million respectively, and their cost to sell were 100,000 and 300,000 respectively. CGU's cash flow forecast for the next 5 years are as follows: pre-tax cash flow, post-tax cash flow. The pre-tax discount rate for CGU is 8%. Post-tax discount rate is 6%. Kanto has no plans to expand the capacity of the CGU and believes that the reorganization would bring cost savings, but as yet no plan has been approved. And the directors of Kanto need advice as to whether the CGU value is impaired. So the whole thing is nothing but impairment testing, and you're given a table for 6% and 8%. So he's giving you options so that you can decide the right things according to the standard. According to IAS 36, whenever you do a value in use, alright, is the PV of future cash flow in the definition in the standard. PV of future cash flow, alright, it must be pre-tax cash flow discounted at pre-tax rate. So you cannot use post-tax. Examiner gave you both to see whether you will choose the wrong ones. So please understand, when you come to writing, introduce the standard again. Any CGU impairment, you must compare carrying value with recoverable amount and choose the higher of recoverable amount is the higher of value in use or fair value less cost to sell. VIU or value in use is the PV of future cash flow pre-tax discounted using pre-tax market interest rate, and the discount rate must reflect current market conditions for time value of money and the risk specific to the asset. And to do forecast, maximum 5 years is recommended. Anything more than 5 years forecast cash flow is unlikely to be accurate. So recommendation is a maximum of 5 years forecast. So in Kanto, if you come in, the pre-tax cash flow for the CGU is as follows. So we take the pre-tax and discount at pre-tax interest rate. So in Kanto, discounted pre-tax cash flow using pre-tax interest rate is year 1 to year 5. This is your pre-tax. Discount 8% factor given will give you a PV. That PV is 28.44 million. This VIU must be compared with fair value less cost to sell. If you follow the question, they've mentioned clearly fair value less cost to sell is the estimated selling price which is PPE can sell for 10 million and 17 million respectively for property and plant and equipment, and the cost to sell is 100,000 and 300,000. So 10 million plus 17 million minus 0.4 million will give you a 26.6 million. 26.6 million is far lower than 28.44. Choose the higher becomes RA. Use the RA, recoverable amount. Compare your carrying value with the recoverable amount. If you compare carrying value with recoverable amount, 32 million is your carrying value. Please take note, given in the question on top, total is 32 million. 32 million compare with 28.44 million. Carrying value is greater than recoverable amount. Impairment loss is a 3.56 million. And in CGU, you must allocate the impairment loss in a certain order. The standard clearly says for IAS 36, first you must allocate to specific asset, then to goodwill, then to other non-current asset prorated. So to allocate this impairment loss, it is allocated as follows: any specific asset, goodwill, other assets prorated, and do not impair this asset below fair value less cost to sell or zero. Very important, this paragraph in the standard. So carrying value is 32, goodwill 3, PPE 10, other assets 19. So we start with the impairment. There is no specific asset, so goodwill goes first. So 3.56, goodwill goes first, 3 million gone. If goodwill 3 million is gone, still got 0.56 to allocate. The remainder should be allocated prorated. Prorated, if I allocate, the ratio is 10/29 and 19/29. If you take 10/29, please take note, the amount of loss you cannot charge here because the recoverable amount or the fair value less cost to sell for PPE is 9.9. How do I know it's 9.9? Question told me I can sell for 10 million after selling cost of 100,000. So the 10 million, please take note, I cannot go below 9.9 because the lowest you can go is, equal to, yes, the lowest we can go is equal to this figure, which is fair value less cost to sell. So if I follow fair value less cost to sell, then it becomes 10/29, which is too high, so I only put 0.1. If it is 0.1, other assets will take 0.46. Alright, so this is what you need to understand, please. So once you got this, it is already impaired 3.56, and 3.56 recoverable amount becomes 28.44. So the 10/29 is actually no use. Why is it no use? Because it goes, if I charge, it will become lower than fair value less cost to sell. Going lower than fair value less cost to sell is not allowed, and this is the issue, please. Alright, so that's how you answer question number 2. Right, that's how you follow this. still streaming?
Yeah, it's still streaming. But my mouse cannot move. Okay, I'm gonna answer.
Finish most of it already. How? So you want to just conclude it?
Almost finished.
Almost finished already.
Oh, see.
Want to conclude it? Shall I conclude and ask them any questions? And you can write as well.
I see.
Cannot write, right?
Yeah, I can't do anything unless I'm restarting the computers and all that.
So, yeah. For example.
Just so telling we have a small technical problems.
Okay, for the next question which I have collected for you is a simple straightforward answer. The answer is given to you. You can run through it. But I just want to show you two questions how we go about doing it in this master class, especially the console part, which I believe should be of great help to most of you. The second question is just to show you how to write on issues, and the third question you can repeat the same thing by reading the answer there. You can see how I approach the issues. You introduce the standard first. From the introduction of the standard, you go down to explaining the standard. So I thought it will be more beneficial if you can give to some question time. Alright, so if there's any question that you want me to help or answer, you can ask me now. Where will they put up?
It will be in the live chat.
So I'm waiting for questions in the live chat. Let's use the time productively, and if you have any doubts on the P2 examination, you can put in the live chat and I will answer your questions now. So please don't hesitate. Any questions you have on P2, let me know. I'll definitely give you an answer based on what I've been teaching in P2. Alright, so kindly put out your questions. I will answer you now. Just wait for a few minutes to see if you have any questions. Please don't hesitate. Any doubts you have, you can check, or any help you need, kindly let me know. Thank you for the compliment, San Tifi. Alright, yes, that's how we do complex group in Singapore. I hope it will help you in Australia, in Sydney. Alright, and I hope it will be a great insight for you to solve it systematically, because the examiner's answers are not very easy to understand. I know the problem with most students. I hope this will be quite useful for you based on what I have got from my previous year's experience. I'm giving you all these methods, so kindly use those methods and finish it within the time given in the exam, which I believe will be very useful. Thanks, Ram, for your compliment. Yes, my answers are very comprehensive. I don't believe in beating around the bush. Alright, straight to the point, because you only have the time to write what is required. kindly try to avoid writing too much things outside. Keep to the point, alright? Stick to the standard. Please know what the question requires. Zero in into the answers. Introduce a standard, link the issue to the answers, and you get a comprehensive way of doing it. Alright? Sure, thanks for your compliments again. Right, my answers will be quite different from the examiner's answers because they are very focused, and I only want to give you what you can write in the time given. Especially the console answers will be very useful for most of you. Try to use it because this exam is definitely going to be complex group after a long break. Okay, thank you very much. And since there are no more questions, I believe that all of you are quite comfortable listening to me for the last 1 hour, 1.5 hours, 1 hour 45 minutes. I hope it has provided you an insight into how to handle P2 paper, alright? And the objective of this master class was to impart a little bit of what we have understood from the examiner's requirement to you. I hope it was beneficial to most of you, alright? And please don't hesitate, alright? My email is saminathan@lsbf.org.uk. Saminathan, SAMINATHAN @lsbf.org.uk. If you have any questions, you can just email to me, and I'm always willing to help as long as you can pass and finish this paper, which is not difficult to pass at the end of the day. So hope you enjoyed the 1.5 hours, and I hope I have helped you to a certain extent, although I can't do much in the time given. So please understand, within the constraints I've done my best. Thank you very much, and I hope to see all of you in Sydney if I come to Sydney to do any lecture in future. Thank you very much. Okay. So this one tomorrow is just, I think it's about 1.5 hours. We cannot take more than that. So anyway, the other answer is comprehensive. Okay. System I think hang already. Hang right.
Hangs. Doesn't want to come up. So.
Okay. Luckily, because the important things are done already. Luckily, if not hang halfway, I'm screwed. You know. I just finished that question.
Thank you, sir.